Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Rocket Pharmaceuticals.
If you find our talks useful, please consider subscribe, like, and comment underneath. So I want you to imagine for a second that you're running this, cutting-edge manufacturing company.
Okay, I'm with you.
And your team has just spent hundreds of millions of dollars in research and development to build this highly specialized product. But here's the catch. Your total addressable market globally is exactly 25 people per year.
Wow. I mean, in almost any normal industry, your board of directors would just laugh you right out of the room.
Exactly. The revenue ceiling is just way too low. You'd be bankrupt before you even scaled your production line.
Right, because it contradicts everything we're traditionally taught about economies of scale. You generally want to build a product once and, sell it to millions.
Yeah. Selling to 24 people seems financially impossible. But then you step into the world of biotech investing and suddenly the normal rules of business just get flipped entirely upside down.
They really do.
Yeah.
And that brings us to the massive thesis-altering regulatory event that just occurred yesterday, March 27th, 2026.
Right, the FDA approval.
Exactly. The FDA officially approved a new therapy called Kresladi. And, this single event instantly transitions Rocket Pharmaceuticals from being this speculative, cash-burning, clinical-stage biotech into a fully validated commercial entity.
Which is basically the holy grail for a biotech firm, right?
Oh, absolutely. It's a profound shift.
Yeah.
But to understand why the market is reacting with such extreme volatility to this news, we first have to kind of understand what this therapy actually does.
Right, like why solving a problem for just 25 people is such a monumental breakthrough in the first place. Let's dive into the biology here because it's honestly fascinating.
It really is. So Kresladi is designed for a condition called leukocyte adhesion deficiency I, or LADI for short.
And this is an ultra-rare disease, right, caused by biallelic variants in the ITGB2 gene. Basically, a child is born with an immune system that just can't properly fight off infections.
Correct. And to your point earlier about the tiny market size, there are only about 25 new cases of this diagnosed annually in the entire United States.
Man, 25 cases. It's the absolute definition of an ultra-rare pediatric indication.
Exactly. To get a bit more granular on the mechanics of LADI, because, well, it's crucial for understanding the value of the cure, that faulty ITGB2 gene means the patient's body cannot produce a specific protein called CD18.
Okay, CD18, what does that do?
You can kind of think of CD18 as the biochemical Velcro that allows white blood cells to stick to the walls of your blood vessels.
Oh, I see.
Yeah, so when you get a cut or an infection, your white blood cells need to stick to the vessel wall, slip through the tissue, and, go fight the bacteria. Without that Velcro, the white blood cells just helplessly float right on by.
So it's like having a million heavily armed police officers speeding down the highway, but every single off-ramp to the actual crime scene is closed. They just can't get to the emergency.
That is a perfect way to visualize it. The immune system is producing the cells, but they literally cannot deploy.
Which is terrifying.
It is devastating. Because of this, patients with severe LAD, I suffer from these recurrent life-threatening bacterial and fungal infections. I mean, a minor scrape can be fatal. Historically, the mortality rate for severe cases in early childhood has just been incredibly high.
Which brings us to how doctors used to treat this. Because to really understand the breakthrough of Kresladi, we kind of need to look at the old standard of care, right?
Right. Up until yesterday, the primary option was an allogeneic hematopoietic stem cell transplant.
That is quite the mouthful.
It is. But essentially, it just means a bone marrow or stem cell transplant from a donor.
And from what I understand, that is an incredibly grueling procedure. To use a car analogy, the old method was like taking out the entire car engine and replacing it with another one from a completely different vehicle.
Yes.
And then you just cross your fingers and pray the new parts don't reject the chassis. You needed a perfectly matched donor, usually a sibling, which is incredibly hard to find.
It's very rare. And even if you did manage to find a match, the procedure carried severe life-threatening risks, the most prominent one being graft versus host disease.
That's where the body attacks itself, right?
Well, actually, it's where the newly implanted immune cells from the donor recognize the patient's own body as a foreign threat. So the new cells begin attacking the patient's organs.
Oh, wow. That's awful.
It's incredibly traumatic for the child and the family. Stopping the body from actively fighting the new cells requires this brutal regimen of harsh immunosuppressants.
Right. But Kresladi is a complete paradigm shift here. It's a pharmacological alternative. Instead of ripping out the whole engine and risking that terrible rejection, it's like a highly specialized mechanic going in and perfectly fixing the exact faulty genetic spark plug.
Exactly. It's a one-time, potentially curative gene therapy. And we should probably explain exactly how they fix that spark plug, because the mechanism is what validates the entire company's platform.
Yeah, let's get into that.
So Kresladi is a lentiviral gene therapy. They literally use a modified lentivirus, which, by the way, is from the same family as the HIV virus, but they strip out all the viral components that actually cause disease.
Okay, so it's not harmful anymore.
Right. Viruses are naturally brilliant at breaking into human cells and inserting their own genetic code. So scientists basically hijack that natural ability. They use the deactivated virus as this microscopic Trojan horse.
To deliver a healthy copy of the gene.
Precisely. They deliver a healthy, working copy of the ITGB2 gene directly into the patient's own stem cells.
And this all happens outside the body, right?
Yes. It's an ex vivo therapy. They harvest the patient's own stem cells, treat them in a lab with this viral vector to fix the genetic code, and then infuse those modified cells back into the patient.
That's amazing. And because it's their own cells, that huge risk of graft versus host disease is virtually eliminated.
Exactly. The off-ramps are reopened, and the white blood cells can finally get off the highway and fight infections.
And since there's no other approved pharmacological alternative for this, Rocket Pharmaceuticals now has this massive first-mover advantage. They've built a distinct clinical moat basically overnight.
They have. But this actually brings us right back to the central paradox of this business model we mentioned earlier.
Right, the bear case. We have to acknowledge this right away. We established there are only about 25 new patients a year in the U.S.
Which is tiny.
Yeah. Even if you price this gene therapy at, say, $2 or $3 million per treatment, the immediate commercial revenue is hard capped by that tiny patient population.
It's a ceiling you simply cannot break through. I mean, you can't market your way into finding more patients than actually exist.
Exactly. And by traditional metrics, $60 or $70 million in peak annual revenue barely even covers the incredibly high costs of complex medical manufacturing and all those clinical trials.
Right.
So Kresladi is not expected to be a major moneymaker on its own. The obvious question then is, how does this company actually build wealth for its investors if the customer base is that small?
Right. Why is the market treating this like a massive whim? Well, this is perhaps the most unique financial mechanism in the entire biotech sector.
I think I know where you're going with this.
Yeah. The FDA approval for this specific type of ultra-rare disease triggers eligibility for something called a Rare Pediatric Disease Priority Review Voucher.
The PRV.
In the industry, yeah, it's called a PRV.
And this voucher is essentially the golden ticket, right?
It really is. A decade ago, the government realized the exact mathematical problem we just discussed. If a disease only affects 25 children a year, pharmaceutical companies will never spend the hundreds of millions of dollars required to develop a cure.
Because they'll just never make their money back.
Exactly. So Congress created this voucher program to artificially incentivize the market. If you successfully get a drug approved for one of these rare pediatric conditions, the FDA just hands you a priority review voucher.
Okay, so what does the voucher actually do?
It allows the company to dramatically speed up the FDA review process for any other future drug, cutting the review time down from a standard 10 months to just 6 months.
And crucially, Rocket doesn't have to use it themselves, right? They can just sell it to the highest bidder.
Exactly. They are fully transferable assets. So imagine a massive multinational pharmaceutical company that has a potential multi-billion-dollar blockbuster, cholesterol drug or weight loss drug sitting in the pipeline.
Oh, I see.
They will happily buy this voucher from a smaller company like Rocket.
Okay.
Getting their blockbuster drug to market 4 months earlier could mean an extra $1 billion in sales under patent protection. Because of that extreme return on investment, these priority review vouchers have historically sold for anywhere between $90 million to $110 million in pure cash on the secondary market.
$100 million. Okay, let me put this into a wealth-building perspective for you listening. Imagine you own a house and you're struggling to make your monthly mortgage payments.
Right.
Normally, to get a massive influx of cash, you'd have to sell off equity in your house. You'd take out a second mortgage, you'd dilute your ownership. That's what clinical stage biotech companies usually do to survive, right?
Yeah, they issue millions of new shares of stock to raise cash.
Which dilutes the existing shareholders and just drives the stock price down. But getting this PRV is like suddenly discovering a winning lottery ticket in your pocket worth $100 million.
Exactly.
You can pay off the mortgage, fund your life, and you don't have to sell a single percentage of your house to do it. It is massive non-dilutive funding.
That is the perfect analogy, because non-dilutive funding is literally the lifeblood of biotech wealth creation. That cash infusion extends their financial runway substantially.
Meaning they don't have to worry about going broke tomorrow.
Right. It means they can take that $100 million and use it to fund the research and commercialization of the rest of their pipeline, treating other diseases, all without punishing the current shareholders.
And Wall Street absolutely recognized this. We really need to look at the price action here because the market's reaction to this new reality is wild. We're looking at what analysts call a classic binary breakout event.
Yeah, the setup was intense.
Before the FDA decision on March 27th, the stock was trading around $4.19. The moment the approval hit, headlines were describing the stock as soaring in the pre-market with just extreme, violent volatility.
What's fascinating here is the market positioning leading up to that exact moment. Heading into the FDA decision, quantitative analysts were viewing Rocket as a pure lottery ticket stock.
Right, because the options market was pricing in extreme moves in either direction.
Exactly. If the FDA rejected the drug or even just asked for more data, the stock would likely plummet to near zero because their cash runway was getting dangerously short.
But if they said yes, it skyrockets.
Right. That is the definition of a binary event, a literal coin flip for the company's survival.
And because it was so inherently risky, a lot of big institutional funds were just sitting on the sidelines, right? Risk management protocols simply don't allow many funds to invest in pre-commercial biotechs with that kind of regulatory overhang.
Precisely. But once that FDA stamp of approval was officially published, that regulatory overhang vanished in a fraction of a second. Suddenly, all those sidelined institutional funds rushed in to accumulate shares because the company had successfully transitioned to a commercial entity.
Which sparks a short squeeze.
Exactly. That massive influx of buyer demand, combined with the fact that anyone who had shorted the stock now needed to panic buy shares to cover their losing positions, sparked a powerful short squeeze dynamic. The sheer volume of buyer demand completely overwhelmed the available supply of shares.
And you know, it's worth noting, this isn't just a hype rally built on a single headline. If you look back at their Q4 2025 earnings context, the company had already started showing some real operational discipline.
Yeah, they really tightened their belts.
They reported a narrower than expected loss, which eased a lot of the fears Wall Street had about out-of-control research and development spending. They were being smart with their cash even before this windfall.
They were positioning themselves to survive the winter, so to speak.
Right. But, and here's where I am genuinely confused, and I really want to push back on something in the analyst reports that followed the approval.
Okay, let's hear.
So, follow the logic here. The stock was around $4.19. They just successfully cured a rare disease. They got full FDA approval. They validated their entire genetic platform. And they just unlocked a voucher practically guaranteed to sell for around $100 million in pure non-dilutive cash.
Right.
Following this news, Cantor Fitzgerald comes out, maintains an overweight rating, and raises their price target to $10. That makes total sense to me.
Sure.
But then Goldman Sachs comes out, maintains a sell rating, and raises their target to only $3. Wait, a sell rating and a $3 target.
I know, it sounds crazy.
Goldman Sachs employs some of the smartest financial minds in the world. They know what a PRV is. Why would they leave $100 million off their spreadsheet? Why the massive disconnect between Cantor and Goldman?
It is a striking divergence, for sure, and it really highlights the battle between two very different philosophies of institutional valuation. You're right, Goldman Sachs knows exactly what a PRV is. But what you are seeing with their $3 target is the result of strict traditional discounted cash flow models combined with ruthless institutional risk management.
Explain that, because $3 implies the company's worth less now than before they even got the approval.
Right, so in a strict discounted cash flow, or DCF model, an analyst projects the future cash flows of a business and discounts them back to today's value. If Goldman's model is heavily weighted purely on Kresladi's immediate commercial sales, which, as we discussed, are strictly capped by a maximum of 25 patients a year.
The spreadsheet is going to spit out a very low number.
Exactly.
But what about the voucher? They can sell that.
Here is where the risk desk steps in. Some extremely stringent institutional models will simply not price in an unmonetized asset until the cash is literally sitting in the bank account.
Seriously?
Yeah. I mean, the PRV market fluctuates. What if it takes a year to find a buyer? What if Congress decides to alter the PRV program entirely? Goldman is heavily discounting that lottery ticket because it hasn't been cashed yet. Furthermore, they are looking at the massive immediate costs of actually launching a gene therapy.
Ah, right, the capital intensity risk.
Exactly. Cantor Fitzgerald, on the other hand, is using a sum of the parts or a platform valuation model. They're looking at the platform validation.
Meaning they're looking at the big picture.
Right. They are saying, listen, if this lentiviral vector safely and effectively cured LAD without causing off-target toxicities, there is a very high probability it will work for the other, much larger diseases in Rocket's pipeline.
So Cantor is pricing in the new reality of the de-risked pipeline and the high probability of the PRV sale.
Yeah, while Goldman's target appears to be stubbornly anchored to immediate cash burn and a refusal to price in the voucher until ink meets paper.
That makes total sense. I mean, it's like valuing a tech company based strictly on the sluggish sales of its first prototype, while completely ignoring the incredibly valuable software patent they just secured for all their future products.
That's a great way to look at it.
But, Goldman isn't entirely wrong to worry about the immediate cash burn.
Yeah.
Looking at the balance sheet, we really do need to talk about the reality of biotech capital intensity. Because to fully grasp the wealth-building context here, you have to look at the ticking clock.
This is the critical tension in the company's immediate future. Just a few weeks ago, in March 2026, Rocket entered into an at-the-market offering agreement, an ATM, for up to $100 million.
Let's break down the mechanics of that for you listening, because an ATM is a double-edged sword.
It definitely is.
An at-the-market offering basically means the company has secured the right to slowly create and sell up to $100 million worth of brand new shares directly into the open market at whatever the current stock price is.
Right?
It's a fast, efficient way to raise cash, but it inherently dilutes the value of the shares you and I might own. If you own 10% of a pie and the company suddenly bakes 10 more slices to sell, well, your slice just got smaller.
Precisely. It provides a safety net, a critical buffer for their commercial launch costs. Because right now, despite the historic FDA approval, they are still a cash flow negative company. And the launch of Kresladi is not going to be as simple as, shipping bottles of pills to your local pharmacy.
Right, because it's an ex vivo therapy like we talked about.
Exactly. It requires highly specialized patient identification, complex logistical coordination to safely transport a patient's living cells across the country, incredibly expensive cleanroom manufacturing to modify those cells, and specialized medical centers to administer the infusion.
The upfront costs of setting up that infrastructure have to be staggering.
They are.
So it's essentially a high-stakes race against time. The company is in an all-out sprint to find a buyer and monetize that PRV voucher before they burn through their existing cash and are forced to aggressively tap into that ATM offering, which would dilute the shareholders and tank the stock price.
That is exactly the dynamic. The PRV is a $100 million golden parachute, but they are currently in free fall, and they have to pull the ripcord before they hit the ground.
Wow.
This sets up a very clear catalyst calendar for the next 1 to 4 months that investors need to watch like a hawk.
Let's walk through that timeline. What are the specific milestones we're looking at?
Well, in April 2026, the immediate focus is entirely on the commercial launch execution. The market wants to see how quickly they can identify these 25 patients, coordinate with the treatment centers, and actually begin the cell harvesting processes.
Because every successful treatment is proof of concept for their logistical network.
Exactly. But the real major event, the catalyst that will actually determine the stock's trajectory, is coming in May 2026, during their Q1 earnings call.
Ah, the voucher update.
Yes. That earnings call will be the critical update on their PRV monetization strategy. If the CEO gets on that call and announces they have officially secured a buyer for the voucher for, say, $105 million, that instantly removes the threat of the ATM dilution.
Because the balance sheet is suddenly repaired.
Right. The market would likely aggressively re-rate the stock higher, and honestly, Goldman Sachs would be forced to update their models.
And we can't look at this in a vacuum either. We have to consider the macro factors as well. The broader sector trends right now in 2026 are heavily favoring rare diseases and orphan drug development. Big pharmaceutical companies are facing massive patent cliffs for their older drugs, and they are actively looking to acquire smaller biotechs with validated platforms.
Which makes Rocket a very attractive target.
Exactly. Plus, if we see a potential Federal Reserve rate pivot later in 2026, meaning interest rates start coming down, that fundamentally de-risks high-growth, capital-intensive biotech valuations across the entire sector.
Right, lower borrowing costs mean these companies can breathe a little easier, and the discount rates analysts use in those DCF models become much more forgiving.
So when you synthesize all of these elements, the very real execution risks, the tight 1 to 4 month timeline, and the underlying clinical fundamentals, what's the final verdict?
We are looking at a very compelling setup. Based on the analysis of the balance sheet and the recent regulatory win, the final bullish score for Rocket Pharmaceuticals right now is an 8 out of 10.
An 8 out of 10. That is a very strong conviction score, especially in a sector known for heartbreaking clinical failures.
It is. The target horizon here is a 1 to 4 month swing trade, specifically tracking the momentum leading up to that PRV sale event in May.
Okay.
The elevator pitch recap is essentially this. Rocket Pharmaceuticals has successfully de-risked its entire lentiviral gene therapy platform. They now hold an absolute monopoly on a rare disease indication with zero pharmacological competition.
And most importantly, they're awaiting a potential $100 million windfall that will completely repair their balance sheet and fund the future of their pipeline.
Exactly.
It is such a fascinating transformation to watch unfold in real time. I mean, it's the moment a science experiment graduates into a functional business.
It really is. And, it leaves us with a broader strategic question to ponder, one that goes way beyond just this single company. Think about the fundamental economic shift we just outlined. For the last century, the pharmaceutical business model has been built on a subscription mindset, developing chronic treatments that patients have to take every single day for the rest of their lives.
Right. That's a predictable, recurring revenue stream that Wall Street models love.
But a one-time gene therapy breaks that model entirely. You are pulling a lifetime of clinical value forward into a single dose.
That's a really good point.
The priority review voucher is a brilliant but ultimately temporary government band-aid to artificially incentivize companies to cure diseases with tiny patient populations. But as we move into an era where genetic platforms are validated, what happens when a company develops a one-time cure for a disease that affects 100,000 people?
Oh, wow. There won't be enough PRVs in the world to subsidize that.
Exactly. So how will global healthcare markets and traditional valuation models eventually adapt to value a permanent cure over a profitable treatment?
That is a massive question. It completely changes the lens on how we view the future of medicine and money. It really brings us back to where we started, too. In most industries, fixing one faulty spark plug in 25 cars a year is a terrible business model.
Terrible.
But in the modern world of specialized biotech, finding that one genetic spark plug, proving you have the tools to fix it permanently, and handing the keys back to a healthy patient, that might just be the most valuable and disruptive business model on Earth.